I think without being able to find the future growth rate to compare it to, you can still use the model effectively because the stock market it's based on what they think is going to happen in the future. And by estimating a current price today, you can get reasonably close to what you think the market is pricing into a company. So if you're looking at a company like CrowdStrike and you're trying to determine, hey, is this really expensive? Like, what does the market think is going to happen? Like, what growth rate are they pricing in for the company to achieve this rate? When I think about the reverse DCF, that's really what I feel like is telling me. I'm working at it from a different point of view. Like, I'm not necessarily a air quote growth investor per se, and so I may come at it from a more conservative viewpoint than other people might. And so if I'm looking at a company like a CrowdStrike or an Uber or Reddit, I might have different opinions on what I think is appropriate. But again, because we're working with the one thing we know for sure, and that's the price, you can make a lot of, I guess, educated guesses when you're trying to determine what the growth rate is. And that's kind of how I think about it. What are your thoughts on it?
How much time do you have? Yeah, there's a lot of ways to use it, and there's a lot of ways to abuse it. And it's hard to use as a blanket tool because there is a lot of nuance to using it. And I know that sounds like a cop out, but as an example, Tesla is, I think, one of those that's been perennially always expensive. It's always you've never really been able to justify the price based on what the business is doing today or historically. But if you talk to people who have been long the stock for a long time, which congratulations, like that's a great
view.
That's a great that was a great pick for you, right? A lot of them will talk about how they see Tesla not just as a car company, but also the like a self-driving kind of robo-taxi company, or a blanking on solar house power cell company, battery technology, all of these things, right? And so where the reverse DCF, maybe you would run it on a company like Tesla and you'd be like, I don't understand, how can they be pricing in, like, I don't know, 100% growth over 10 years or something. Sometimes there's other pieces to that picture that maybe make the reverse DCF start to make more sense. Like, oh, okay, they are assuming that maybe it's not that they think the car market will grow by this much, but they think they're going to execute with robo-taxi and they're going to take market share from Uber or something.
Right.
And so there's a lot of assumptions that can go into that kind of thinking. Like, and I know I'm getting super in the weeds with this, but just follow. If I don't know what Uber's operating margins are or what their end profit margins will be, but I'm going to take the risk of assuming that those are going to be much higher profit margins because it's maybe close to like a software company kind of margins. And so we might look at Tesla's revenues and be like, well, how can the market be projecting this high of a revenue growth? But maybe they're projecting software-like margins on the robo-taxi, right? And so that makes it very hard because now you're just throwing more assumptions into it. And so I would say for some companies, a reverse DCF maybe is more vanilla, and people are thinking more of like, here's where the company is now and here's maybe where it'll be in 10 years. But in other instances, you can justify a lot of outside of the box thinking, which is what the market does actually. Like they do. I don't remember what book it was because I was reading it like 3-4 months ago, but he said like investors are a romantic bunch. and we really are. And we love to fall in love with companies and stories. And sometimes that's what's driving a price. And
Mhm.
so is a reverse DCF the right tool for a stock like that? Maybe, maybe not,
Mhm.
but I doubt it.
Yeah, that's the hard part, right? Is like, is it does it work with a story stock, and does it work with Johnson and Johnson? You
Right.
know, it can work for both. It just depends on what kinds of assumptions or assuming we're going to take a chance on doing. I think, you know, you've talked about this in the past, and one of the ways that I try to ground myself a little bit is by looking at not only industry norms, if you will, but also base rates of
Mm,
things. Michael Mobison's great base rate book can give you some pretty good insights into what is realistic or can be realistic, keeping in mind that none of this is a hard fast rule. We still are guessing. And that's, you know, you can try to make more educated guesses. And if you have a lot of experience in a particular industry or sector, it can be helpful for sure. But to what you were, you know, to your point that you were making about Tesla, there's a lot of different components that go into valuing a company, not just Tesla, but many companies, especially in the tech world. There's not a lot that just do one thing. They do lots of different things, and you have to kind of encompass that and think about what is the market pricing in for the growth of AI for Google, for example,
mm,
and how is that impacting the valuation of the business? And it's not easy, and but I think using it in conjunction with other tools, whether it's a normal DCF, whether it's other ways of valuing companies, I think can be really helpful to just give you a more well-rounded picture, as opposed to just going, okay, hey, I slapped some numbers in the reverse DCF and it gave me back this growth rate. All right, that sounds legitimate, and then moving on. You need to do a little bit more work before you just kind of accept what the model gives you.
yeah, I love that idea. It's the free cash flow of the firm model is what most of Wall Street uses apparently.
Hmm. Hmm.
So it's not just revenue growth, that's a big input, but also return on invested capital,
Hmm.
also operating margins, also your terminal value,
Hmm.
which whereas ROIC can kind of play into that part too.
Right.
So yeah, be careful about I like how you say like don't just take it immediately at face value and say, okay, I'm done, I figured it out. It's
Right.
very rarely that simple.
No, it's very, very rarely that simple. And the other danger of using these models is if you're drinking the Kool-Aid, sometimes it can give you the answer you want, or you can
Mm,
you can manipulate them to give you the answer you want. And that's where you
mhm,
have to be careful.
mhm. Yeah, that's a good one.
Yeah, very careful. All right. So let's move on to the next question. So we got, do you utilize stops or other hedging techniques on your positions when you feel like they've become frothy or overextended? I'm sure we have all experienced a 30 to 50% haircut on high growth stocks, which always feels painful, and just wondering if you consistently employed any preemptive measures or just trusted the process of picking solid companies. So this is a great question. This is from Kurt. And we haven't really talked about this in a while, but what are your thoughts on maybe this kind of idea?
I used to use trailing stops and I found it didn't work for me, especially because I'm an unapologetic value investor sometimes.
Mhm.
And part of doing that means buying stocks that are going through tough that it's sometimes I look like a genius because I buy at the absolute bottom and then
Mhm.
rebounds. I'm like, oh yeah, that's how it's done, ladies and gentlemen. But other times, that downtrend continues, and if you still have conviction on the stock, then using a trailing stop to stop out of it is counterproductive, and it has burned me more times than it's helped. And so, because of that, I don't use them anymore. And a trailing stop, by the way, is basically you place like a floor underneath the stock price. So if a stock's at 100, you have a floor at 75, and you say, if the stock drops to 75, I'm going to sell. And then it trails. So as it goes up, your floor kind of rises with the stock. And that can be helpful because if things turn with, it's a stock that's gone up for years and then something bad happens in the company and then things turn, it can get you out at a pretty nice profit and, in theory, keep you away from all that downside pressure that could come.